In this video, I want to talk a little bit about our day trading opportunities that we had today here in the indexes. The first thing I want to do is I want to pull up our calendar and our economic calendar today for Wednesday the 15th. And I want to just slide down through here, and you'll notice that we had a lot of U.S. flags in here. So, of course, all these little U.S. flags means that there's some activity going to be happening in the market today. Now, most of them were medium to low. We had one high, which was listed here as a high effect. USD retail sales came in. And the thing that I always mention to people is that if you see a whole string of reports coming out, it's going to be a good day to trade. Now, I don't always look at this and say, I'm looking for the market to be bullish or I'm looking for the market to be bearish. I don't look at this necessarily for bullish and bearish activity. I don't decide what the market's going to do based on the news. I'm not that guy. I'm not looking to say, oh, I'm expecting the market to rally, and so I'm going to take all long positions today because the economic calendar is saying XYZ, and we're anticipating that this is what it's going to be, and if it says it's lower, we're going to go long. If it says it's higher, we're going to go short. I don't do that. I'm not that guy. All I'm doing is I want to see lots of high activity, lots of reports coming out for the U.S., and when that happens, I think the market's going to move. And we're in the futures market. We can go long just as easily as we can go short. We can make money when the market goes down, make money when the market goes up. And it's not for us to decide which direction the market's going to go. We just go with whatever direction the market does go. So we use our technical analysis as setups and triggers for entry of the fundamental news. So the news that's coming out in those economic calendars, that's the fundamental news. Those are the only days we day trade. We don't day trade any other day. A lot of guys get stuck in this idea that they need to be day trading every single day. We only day trade on the days that we have good economic calendars, indicating that there's going to be some movement in the market. Whether it's bullish or bearish, we don't care. We're going to use the setups that come in from our technical tools, our technical indicators, to help us know when it's time to enter into the market. And as you can see, I've got the S&P pulled up in here, and you can see today's economic calendar moved the market today. So this is the time that we want to trade. Now, when we come in here and look at this chart, if we go to the range bar 6 and we slide back to the beginning of the day, you'll notice that we had lots of chop in here. And that's all this preceding all that time frame before the news reports came in. So we have to keep that in mind as well. Hey, it's an economic calendar that says there's going to be lots of activity today on these very short-term time frame charts like the range bar 6. Usually you want to wait until those reports come out before the market starts to move. Okay, you're going to get a lot of drifting sideways. Now, that said, there's oftentimes you'll see the market will move prior to the news events. Now, look at this. This is where the news events came out, and then, of course, the market started to take off, and we had lots of great trending opportunities for entry into these markets. Now, this is a very small time frame range bar 6 chart. Once we get into the market, move our stops to break even, we generally want to get off this chart and move out to the longer term time frames. So here's a 2-minute chart. And you can see, and what I was about to say earlier is that we oftentimes want to move out to these longer term charts and look at the pre-market setup. Okay, and because there's oftentimes good trading opportunities out in the pre-market. So this is coming into the news reports. As you can see on the 2-minute chart, this market actually had a nice signal and a big drop coming in out here on the longer term time frame. Now I say 2 minutes. 2 minutes is a longer term time frame. That's because a range bar 6 is so small, so sensitive. It's about as low as we want to go. But the 2-minute chart gives us this longer view of the market, and you look at that out on this longer term time frame. I'll always tell you, we want to look at that range bar 6 chart just for entries to get us into the market, and then we want to try to move out to these longer term time frames, catch longer term trends. And we can also use the range bar 12 very effectively. You can see that in here the range bar 12 has been making nice trending moves as well today. Coming into the pre-market session, we had this drop off of here down here. That was a $1,000 move just off of the pre-market session from arrow to arrow. Of course, you had some blue lights in here with an ABC pattern. You had a re-entry point right in here with the blue light to the next level down, depending on where you got into this market. Now, most of us are sleeping during this time here in the U.S. We're not up. We're not taking these positions on the pre-market session. This would be our entry or our look for entry here to the long position. You can see we had a 3-drive pattern. So drive 1, we have our little counter trend coming in here with our re-entry point. Of course, this is drive 2, and this is drive 3, and right in here would be our counter trend for a re-entry to the next long position on this chart if we miss the first opportunity, the second opportunity, and the third. There's our third opportunity with that 3-drive pattern to the top. We're done. This is it. We're hit the 3-drive pattern. We're out. We come back to the 2-minute chart, and you can see we had a couple of different locations in here where the arrows crossed. We had drive 1, we had the intercept right in here, we had drive 2, we had the intercept right in here for the next long position, and then we had that 3-drive pattern once again. Again, coming back to this, I can teach you the technical side of things, take the arrows, take the intercepts, all this kind of stuff. The part that's hard for people to catch on to is that we don't trade every day. Don't trade every day. You trade the days where the economic calendar tells you there's going to be a lot of activity, and then don't pick a side. Don't say I'm bullish, I'm bearish, because you don't know. I don't know, and I'm not going to try and understand and read those reports to decide whether I'm going to be long or short. I'm going to take what the trend gives me. All right. If I get a signal, if I get a technical signal and all the setups and the triggers are there, I'm going to go in that direction. And then I'm going to watch. I want to take the trend. The trend is your friend until it bends or ends. All right. And so these are locations in which the trend can bend and end. Now we can get in with multiple contracts. We can get in with 2 in here. We can take one off at the quick location, keep one at break even, and go for the next arrow. This would be a reversal of that arrow. If we went in with 3 contracts, we could do the same thing. Take one off here, take one off here, keep one in till the end of the day, which would be the end of this green line. Right in here would be kind of an exit point if you're a day trader for that third contract in the morning. If you in this situation, okay, it's every situation is different how you want to attack it. Sometimes you might think, oh, I'm here on the mini market and the mini contracts, and that's a big move, $1,600. That's too much money of a risk for me. I'm a smaller trader. Well, we have that opportunity for you now where we can use the micro minis. And we can go down and we can trade multiple contracts simultaneously and still be way underexposed to what we'd be if we were just trading here on the mini accounts. So keep that in mind as well. You can trade a more aggressive, higher number of contracts when you're down on the mini micros, if that's your flavor. So if we come down here, I'm going to delete these out. And another strategy. Okay, I'm one of these guys that likes to take off positions as the market moves in my favor. So I'll get in with multiple contracts. I like to get in with 2 or 3, and then as markets hit certain points, take them off and liquidate my positions. That's taking a bigger risk in the beginning. You have to realize that. That's a choice that you make on whether you want to get in with 2 or 3 contracts initially and then liquidate them off very quickly as the market moves in your favor, or if you're the guy that wants to get in conservatively, put on 1 position, and then as market hits new trigger points, add on additional positions. All right, so you can add on here, you could add on here, and take all 3 contracts off at the top. And that would be a different method. It's just kind of the reverse strategy of doing the same thing, only in reverse. So you need to kind of decide which way works best for you. I'm the kind of guy that likes to take them off as the market moves in my favor. Not real excited to add them back on, although that's also an additional advanced strategy where you can come in here and you do a combination of both. Rather than saying I'm going to get in with 1, add on 1 to the top and end up with 3, or vice versa, coming here with 3, take one off, end up with 1 at the top, you can do a combination. You can get in with 2, take 1 off, add 1 back on. At this point, take 1 off, add 1 back on, and end up back up at the top with 3. So there's ways that you can play these Elliott Waves positions. Again, like I said, my strategy, the way I choose to do it, is by adding on 3 at the beginning and then liquidating off, or 2 at the beginning, liquidating off, and adding 1 back on. So the strategy I've been doing most lately is putting on 2, taking 1 off, putting 1 back on, and then adding on again if I feel like I want to add on again. But I'll generally end up at the top with 1 order as opposed to 3. And so that's kind of my strategy. I'd prefer to do it that way because you have to be prepared with your strategy to accommodate that. Okay, so let's quickly jump down here to the NASDAQ. I'm going to show you these other markets, the Russell and the Dow. The strategy was basically the same. The trends were basically the same. These 4 markets all run very similarly. What happens is you get the changes where these are different is the aggressive nature of the markets down on a smaller term time frame. It seems that the NASDAQ and the Dow are a little bit more aggressive. They run a little bit harder. They have a little bit more movement in there. We oftentimes use those as leading indicators to the other markets like the S&P and the Russell. If you want a little bit slower market, something that's a little bit less aggressive, isn't moving up and down quite so much, the Russell and the S&P seem to be those 2 markets that are a little bit less aggressive. So different trading strategies. Oftentimes if you're scalping, you want a market that's moving up and down so you can get some movement to fill your positions. That would probably be better done maybe on the Dow and the NASDAQ for a little bit more actionable trading environment, whereas the S&P and the Russell again are a little bit slower. Still aggressive market, still fast in any right, but nonetheless not as aggressive as the NASDAQ and the Dow. So those are the different patterns. You can see the opportunities that we saw down here on the 2-minute chart on the 4 indexes today. All right, so that's just a quick summary of what happened today in the E-mini S&P. Really consider the days that you trade. You don't day trade every single day. Watch those markets. Be very careful. Watch when there's lots of activity going to happen based on the news of those economic calendars, and I think it'll significantly help your trading. All right, guys, we'll catch you next time.